How long can we really see a bounce for? How do you make of the bounce?
Well, we always see some bounces in the market, and this is, to my mind, is more of a bear market bounce when we look at the inflation picture, when we look at the Fed hiking cycle that we're in, and the effects that that will have on economic growth. It's unlikely that in this environment, financial assets will continue to bounce.
Maria, good morning to you from London. It seems as if this most recent bout of positivity that seems to have infected the markets, if that's the right word, is being driven by shifting expectations at the margin about what the Fed is going to do. Maybe some investors got a little carried away with thoughts of 100 basis points, and actually maybe it looks more like 75. Are investors right to continue, well, to pull back some of those more aggressive expectations for rate hikes?
Well, we have to keep in mind that monetary policy works with a lag. So, the original scene of the Fed has been the massive accommodation that it did in 2020, in March of 2020, at a time where the COVID situation was best addressed through fiscal policy, which eventually we did see. So the massive accommodation that the Fed did at that time laid the foundations for this inflationary environment that we are currently seeing. Now, we have to keep in mind that monetary policy works with a lag. So having very aggressive hikes at this point can potentially damage the economy down the road. The reason is that once a hike happens, the effects on the real economy can take up to 1 or 2 years to show. So being very aggressive at this point in raising interest rates could have long-lasting effects on economic growth and scars that would take years to be healed.
So, Maria, would you be on the camp that you got to carefully front load hikes now, but then cut in early 2023? Or is it more inflation's going to be stickier than we all think? The Fed's going to have to hike to 4, maybe above. That's not priced into the market.
Inflation is going to be stickier than we think, and that the problem this time around is that much of this inflation is outside the control of the Fed, because largely it's driven by supply side issues, and particularly in the commodity markets, we see what's happening on the energy side. And part of the problem is that we've been going through this global campaign for transition to alternative energy, which I think it's the right thing to do because it protects the environment. However, to do this effectively, you need to have a well thought out transition strategy. The problem is that this has not really happened. So we live in a world where E is hurting S and G is not helping. So we are in an ESG world that creates a lot of other unintended consequences. So hiking now, the only way that the Fed can control inflation is by a massive demand destruction. Supply is not responding because we haven't seen the incentives in the market for producers to increase production and therefore bring equilibrium in the market. So inflation will continue to be elevated, and the Fed cannot do very much to control it.
Right, that's interesting, Maria, because some people talk about that in the European context, in the ECB context, and say in the Eurozone, even more of the inflation is still being driven by energy markets and disruptions to energy markets, and therefore that can't be attacked by monetary policy. There's less demand side sort of inflationary pressures to clamp down on in the Eurozone than there are in the US. But you think those arguments apply to the US as well?
Well, we have seen a lot of disincentives from the administration to really increase production in the energy sector in the U.S. So companies need visibility for the next 5 to 10 years in order to be able to plan investments, and that's not something they're getting. And so, despite the high prices, typically when you see high prices in commodities, that will lead to higher production, and therefore you're going to see an equilibrium in the market. This time around, you don't see that. And increasing supply from other sources, such as Saudi Arabia, is not really feasible because they have really topped out on their production.
Which, to your point, this is like a structural shift with ESG rather than a cyclical temporary inflation. So with that in mind, that to me means, where I would think, more volatility, every asset class.
Yes.
Is that true? And if it is, what do you do? You're multi-asset. So like, where do you go to either play the volatility or protect against the volatility?
There is no question we're going to be continue living in a world of high volatility. We're going to see violent rallies and then pullbacks in the market until we see some stabilization of inflation. Once inflation stabilizes and we see it coming down, then it's the time where we're likely to see equity markets bouncing back in a more lasting way. And that's probably the time when the Fed will feel comfortable easing their hiking cycle.
And Maria, for the rest of the world, for the world outside the United States, strong dollar, of course, has been, to varying degrees, causing headaches. Is that going to be a source of the volatility from here? Does that continue to be a theme?
That's certainly a problem for the rest of the world because a lot of commodities are denominated in dollars. Also, a lot of developing countries have debt denominated in dollars. So certainly a strong dollar is not helpful for growth in the rest of the world.
What's your best multi-asset allocation strategy right now? What would you recommend?
I think at this point it's very important to stay balanced. We do like quality stocks. It's hard to pinpoint to a particular sector, but trying to go for quality stocks that are resilient to the current environment. We see that the correlation between equities and bonds getting restored, so that means that fixed income can protect a bit risky assets at this point. We are a bit less favorable to credit at this point because most likely we are going to head into a recession. The probability of a soft landing is very low unless we see a quick resolution of the war in Ukraine, a reversal of the sanctions, which is highly unlikely to see at this point.
Maria, you say a balance then, and quality stocks. Does that take you into energy stocks? You've talked a lot about what is missing from the energy space, the amount of investment that has not happened in the transition in recent years. Are you attracted to energy at these levels?
Yes, I am, and I think that no matter what happens with alternative energy, and we should continue to invest in that space, we will always need to have a portfolio of energy sources in order to have resilience in terms of energy supply at different parts of the world. So the idea that we will completely decommission fossil fuel, I don't think it's likely to happen for a very long time to come. The important thing is that the regulatory environment provides the incentives for companies in that space to invest and continue to support the market as the transition to alternative sources of energy happens.